Oracle just posted a number that is, well, it's absolutely mind-bending. A record-breaking $638 billion AI backlog. Normally, a number like that sends a stock straight to the moon. But instead, Oracle's stock just suffered its single worst week since the dot-com bust back in 2001. So what gives? How does a company secure over $500 billion in future revenue and then trigger a massive sell-off at the exact same time? The answer to that massive contradiction comes down to a frankly terrifying financial reality. Negative $23.7 billion. That is Oracle's free cash flow for fiscal year 2026. You see, the market suddenly woke up and realized that hiding beneath all that massive, completely real AI hype, there's a serious financial challenge brewing. Sure, Oracle is generating record cash from its traditional software side, but they're spending almost double that amount just to physically build out the data centers needed to handle all this new AI demand. To really grasp why this matters right now, we have to look at what Oracle actually does today, because this is definitely not your dad's legacy database provider from the 1990s anymore. By aggressively expanding into Oracle Cloud Infrastructure, what they call OCI, they're essentially becoming the critical cross-cloud plumbing that powers this entire AI revolution. We're talking about heavyweights like Microsoft, Google, and Amazon, all actually relying on Oracle's high-speed computing platforms to train and run the next generation of artificial intelligence. And hey, if you're as fascinated as we are by the companies literally building the physical infrastructure for our next generation technology, you really should subscribe to Future Ready. We're constantly exploring how AI, cloud computing, and next-gen tech are completely rewiring the financial world. Joining the community means you'll always get these deep, unbiased market analyses. Okay, so the entire foundation of the long-term Oracle bull case rests on one very specific metric, RPO, which stands for Remaining Performance Obligations. Now, in plain English, that just means total contracted revenue that a company expects to recognize in the future. So, when Oracle's management gets up there and touts that staggering $638 billion figure, this is exactly what they mean. It is contracted, locked-in future business. It's the ultimate proof that the AI demand they're seeing is 100% real. And this backlog, it builds the ultimate bull narrative. I mean, Oracle's tech is undeniably winning the market right now. Just look at the numbers. Cloud infrastructure revenue shot up an incredible 93% year over year. They're locking in these massive, multi-year deals with the absolute biggest players in the space, OpenAI, Meta, xAI. And here's the craziest part. $75 billion of that backlog actually comes from prepaid or customer-supplied GPUs. Their clients are literally fronting the hardware costs. With demand exploding like that, it's no wonder management is guiding for a massive $90 billion in total revenue by fiscal year 2027. But here's the catch. The crucial point of tension, and really what's violently dividing Wall Street right now, is trying to reconcile that incredible revenue growth with the absolutely grueling cost of executing it. On one hand, you have this beautiful 93% growth in cloud infrastructure, but on the other hand, you have a 162% surge in capital expenditures, hitting $55.7 billion. So the market is asking one very simple, very scary question. Can Oracle actually fund and build all of this without completely nuking its balance sheet? And that unprecedented explosion in capital expenditures is playing out in real time. Back in fiscal 2025, CapEx was sitting at $21.2 billion. Fast forward to fiscal 2026, and that number more than doubled to $55.7 billion. And looking ahead to 2027, estimated spending is scaling up toward an eye-watering $90 billion when you factor in those customer prepayments. This hyper-aggressive spending spree is exactly what wiped out Oracle's cash flow. They are simply spending cash way faster than their highly profitable legacy software business can print it, all in a desperate sprint to win the AI infrastructure race. And there's a very real human and operational cost to this massive pivot. 21,000, that's the number of employees Oracle cut from its global workforce over the past year. That is roughly 13% of its entire staff. Management even explicitly stated in their regulatory filings that the adoption and deployment of AI technologies fueled these reductions. This was a massive restructuring effort, and it cost them $1.8 billion just in severance and exit costs alone. What it shows us is a company aggressively ripping every available dollar away from legacy operations and shoving it straight into the data center build-out. Honestly, cutting through the noise to understand the hidden financial realities behind these massive tech shifts is exactly what we do here. If you want to keep navigating these high-stakes tech transitions with clear, level-headed analysis, following Future Ready really is the smartest move you can make. We separate the headline hype from the cold, hard balance sheet reality. So, how exactly is Oracle financing this monumental infrastructure build-out? Well, to fund these data centers, they've taken on some very aggressive leverage. Total liabilities have ballooned to nearly $218.7 billion, with over $122 billion of that sitting just in long-term debt. And since their free cash flow is deeply negative right now, they just have to keep raising more money. Management is planning to raise an additional $40 billion in fiscal 2027, which actually includes a $20 billion at-the-market equity share program. For existing shareholders, that's a tough pill to swallow because it means your ownership is actively being diluted just to keep these AI construction engines running. Plus, there's a highly speculative risk factor hiding inside that massive $638 billion RPO that I think is vastly underappreciated right now. Nearly half of it, an estimated $300 billion, is heavily concentrated in one single contract with OpenAI. Now, obviously, that's a phenomenal win today, but it creates massive customer concentration risk. Think about it. If OpenAI ever faces solvency issues down the road, or even if the broader AI investment cycle just cools off a bit, a huge chunk of Oracle's celebrated future revenue could suddenly be on very shaky ground. Which naturally brings us to the valuation. When you glance at Oracle's equity market cap, it's sitting around $662 billion. But that doesn't tell the whole story, not even close. You have to look at the enterprise value, which factors in that massive net debt load. When you include the debt, Oracle's true price tag pushes well past $700 billion. That means the stock is trading near 25 times forward earnings. And frankly, that isn't obviously cheap, especially when you compare them to peers like Microsoft or Alphabet, who boast much cleaner, cash-rich balance sheets. You're effectively paying a premium multiple for a business that is currently bleeding free cash flow. Now, for the swing traders out there trying to navigate this volatility, the technical damage on the chart is pretty severe. Oracle just experienced a brutal rejection right at that $250 earnings spike, which completely broke its ascending support trend line. Crucially, those short-term moving averages, the EMA 21 and EMA 78, they've crossed over and turned into heavy overhead resistance. Right now, the critical downside support levels you have to watch are $160, and if that breaks, the cycle low down around $135. Make no mistake, the burden of proof is sitting squarely on the bulls to reclaim that $200 level. Looking ahead, we've got a clear timeline of events that could act as catalysts to either reverse this negative momentum or, accelerate the decline. In June 2026, we obviously just saw that massive Q4 earnings volatility as the market choked on the CapEx shock. Coming up in October 2026, we have the Oracle AI World Conference. That's a major midterm event where they might announce new partnerships or, hopefully, some margin-stabilizing technologies. But the ultimate test? That comes in 2027. That is when this massive backlog monetization absolutely must accelerate and start turning all that negative cash flow back into the green. Before we synthesize all of this data into a final trading matrix, take a second to hit that subscribe button and join the Future Ready community. We're building the most informed network of retail investors who are seriously exploring the future of tech, and we would love to have you on board for our next deep dive explainer. All right, let's bring it all together into a clear, actionable risk-reward matrix for the swing trader trying to figure out whether to buy, hold, reduce, or just wait. In our bear case, AI demand softens, or those OpenAI concentration risks actually materialize. CapEx keeps burning cash, dilution stings the shareholders, and the stock breaks down below 160, heading toward 135. In our base case, we get steady cloud growth and stable margins, but that debt remains a heavy overhang, which leads to choppy, sideways consolidation below $200. And in the bull case, that massive RPO converts to revenue rapidly, cash flow turns positive earlier than anyone expects, and the stock forcefully reclaims $200 to push right back toward all-time highs. Ultimately, Oracle's long-term business quality is undeniable. They've successfully positioned themselves at the absolute dead center of the AI infrastructure revolution. But the short-term stock valuation is currently colliding head-on with the painful reality of financing that future. They're taking on massive debt and diluting shareholders to build out data centers long before the cash actually arrives. So the final question you have to ask yourself as an investor today is this: is Oracle's massive AI build-out a visionary triumph that will dominate the next decade? Or is it a capital trap that's going to crush short-term returns? Let us know what you think in the comments and drop the name of the next company you want us to analyze.